Good morning, everyone. Thank you so much for joining us today. We're excited to see you. My name is Rachel DeGrand, and I help coordinate the webinars for Houseman Johnson Insurance and the Benefit Services Group. And I want to welcome you to today's webinar, Uncovering the Mysteries of Your Business Insurance Premium. Here we go. Before we begin, I do have just a few housekeeping items. This webinar is interactive and will feature a question and answer session. You can type a question in the questions feature and we will address it after the presentation portion. Once the webinar concludes, there will be a short survey we hope you can complete with your feedback. And this webinar will be recorded and will be available on the webinar archive section of our website. And each attendee will receive a follow-up email with a link to the recording and the presentation slides. And now I'd like to introduce you to our two presenters this morning, Diana Schmidt and Alex Bauer. Some short little bios about them before we get started. Diana Schmidt joined our team in 2017 with over 15 years of property and casualty underwriting and claim experience. She spent a decade of her insurance career as a multi-line underwriting officer at Travelers Insurance. In this role, Diana excelled at building trusting relationships, designing robust coverage programs, and which helps clients control their total cost of risk. Diana thrives on being a true advocate and problem solver for her clients through her underwriting expertise and service-focused approach. Di holds a Master of Science in Insurance Management from Boston University, as well as a bachelor's degree from the University of Wisconsin-Madison in Sociology and Legal Studies. She is a lifelong learner, as you can see from the multiple insurance designations behind her name on our screen up here. And Alex Bauer joined Houseman Johnson Insurance in 2012. Although he primarily works with real estate and hospitality clients, he also enjoys working with construction and contractor accounts. Alex is quick to break down complex concepts and communicate how a client's insurance programs fit within their agreements in a timely manner. He is a regimented and consistent advisor who always has a desire to learn new things and how to better apply solutions to the businesses he assists. Alex graduated from the University of Wisconsin-Madison with a bachelor's degree in music education. Because of his passion for education, Alex has an exceptional amount of tools and resources at his disposal to solve problems, such as all of his insurance designations that you see behind his name on the screen as well. And as you may have figured out from those introductions and all the letters behind their names, Di and Alex have an abundance of knowledge on this subject today. I've learned a lot from both of them over the years we've worked together, and I'm excited to have them presenting today. Welcome.
Thanks, Rachel.
Welcome.
Thanks, Rachel.
Yeah.
All right, so today we're going to talk about a few things. As you can see from the title, we're talking about insurance premium costs and where those numbers come from. They're not pulled out of a hat, out of the ether by a magician. So we're going to start off, and Di is going to talk about global factors impacting the insurance industry and pricing. Then we'll move on, and I'll talk about some more specific business characteristics that your individual business may have that affects your pricing. And then we'll talk a little bit at the end about just how to use all of this information, how to put it together to make good decisions for your insurance buying and risk management costs. So Diana, let's take it away and start talking about the global insurance industry.
All right, thanks, Alex. I'm really excited to talk today about the bigger picture items that could impact your insurance premium. These are going to be things that might be outside of your control, usually are outside of your control that are happening. So like Alex said, he's going to talk about the things that you that are intrinsic to you. And I'm talking about things that can impact any business in the country. So we will talk about the market. The property and casualty industry is cyclical. What that means is that it kind of ebbs and flows, and a lot of the times it's tied to things that are happening in the economy. There's hard markets and soft markets, and where the market is can impact what you might see on your renewals. So a hard market, it's going to feel like you're getting maybe hit hard. You're going to get a rate increase. You could have your agent or broker tell you that the carrier you've been with has changed their underwriting appetite. They're no longer interested in insuring you. Those kinds of things. Maybe they raise your deductible. or simply just say, hey, it's we need more money if we move forward insuring you. A soft market is a buyer's market. That's when you're feeling good about it. You get your renewal and your agent says, hey, your premium went down. The rates are lower than last year, or they offered higher limits on your umbrella for the same premium. Things like that happen during a soft market. And what happens really is that if there's a lot of competition between the carriers for your business, you get more favorable terms and conditions. At any point in time, the market is fluctuating between this hard and soft market cycles. And if we take a look back, you can kind of see how this aligns with a little bit of history. Now, I'm not a history major by any means whatsoever, so bear with me. And if you have questions, make sure you ask Alex, because he's the educator here. So if you take a look here at this, this quick look back over, a few decades, in the 80s, the very early 80s, it was a soft market. What was happening was that there were losses happening with the carriers, but there was a good economy. There was high investment income. So the carriers didn't have to make an underwriting profit as much. It wasn't as important at that point in time. They were able to be competitive and offer good rates. If you move forward to the mid 80s, the investment income tightens up a little bit, and the underwriting losses continued, and the buyers, for you, started to see that you were paying higher premiums, rates were going up, and things like that. That lasted a few years. In the 90s, again, the economy was doing much better. The stock market was booming. It fueled intense competition between the carriers. So everybody was fighting for your business. They had strong incentives to be as competitive as possible to try to gain your trust and earn your business. They had strong investment income coming in, so they could withstand the losses that were happening from the larger catastrophes like Hurricane Andrew in 1992, for example. They were still able to make a profit.
And I would add one thing here. Think about the interest rates. Those of you that were buying houses in the 80s, what was your mortgage rate? So those were the kind of interest rates that the market was sustaining then. And then compare that to today, where you're paying what, 3% interest? Well, the investment income is earning those interest rates. So you can see how that's different today. But go on.
Yeah. So that kind of, it was good for people, for buyers of insurance. And then, the early 2001, there was a lot of tragedy that everybody felt with 9/11. The loss of life alone, was terrible, but it also fueled the economy started to tank. There was a lot of losses that came out of September 11th from an insurance standpoint, $36 billion between property, liability, life insurance, things like that. And the market started to harden again. We didn't end 2001 strong, so if September 11th wasn't enough, then we had the Enron scandal that really just made it the perfect storm that fueled a hardening market. And in 2002, it was the first true hard market that we had seen in over 20 years. Luckily, it started to rebound in 2003, and we have been experiencing a relatively soft market up until the recent year or two. So, you guys, the buyers of insurance who are paying the premiums, you really had vigorous competition in the early 2000s, mid to late 2000s, I should say, and experienced, it was a buyer's market. Entering 2019, you'll see here this chart is a chart that shows what the rate increases or decreases have been historically, quarter by quarter, by line of insurance for the last 3 years. What you're seeing here is showing that the market has been slowly hardening. So on most lines of insurance, the carriers have been increasing rates. Now this is across the country data, so not necessarily Wisconsin specific, or but across the country. And what you're seeing is that the certain lines, for example, like the auto line of insurance, the carriers have been taking rate increases every quarter, going back, I mean, even further than 2017. They have been slowly responding to different things like, Alex, what do we see? Distracted driving,
Yeah.
Just
everyone has this in their hand when they're driving, and that's caused a lot of problems.
Yep. So overall, on most lines of insurance, you've seen an incremental increase in rates quarter after quarter, year after year here, showing that the market is starting to harden. So why, right? So why is this happening outside of, if you look at auto, it's not hard to see what's happening, but why the other lines of insurance? On the next slide, I list a few things. Now there's a lot of factors that can contribute to it from a global perspective, but a few things that we're going to talk in a little bit greater detail today about. Like we said, up until the late 2000s, we had eroding prices, weakening terms and conditions. The buyer's market was finally starting to take a toll. We're going to talk a little bit about catastrophic losses and how that can impact your premiums. And then rising claim costs and social inflation. And again, that lower interest rate level is something that really dictates what happens with your insurance premiums, because at the end of the day, the insurance companies are for-profit businesses, and they need to figure out how to cover their costs and expenses, pay your claims, and make a little bit of a profit so that they are, around for the long term.
And that's a good point there, Di, is that, the increasing premiums, we, as much as we don't like to hear the insurance companies making profits, people don't like to hear that, but we do need them to be solvent in order to pay all of the claims. So that's why we're headed in the direction that we are.
Right. Yeah, you definitely need them around to pay claims. I mean, that's the whole, the whole purpose of insurance is to, transfer that risk to the insurance carrier. You want that carrier partner to be there for you when you need it the most. So, all right. So let's move forward to the next slide. So those are the things we're going to start chatting through here. This is another, this is the last number slide I have, I promise. So what we're looking at here are combined ratios by line of business. Now, these are financial ratios that kind of show if the carriers are, how they're doing from a profit standpoint. It's going to take into account the claims and expenses they're paying compared to their premiums. You really want this to be a debit number or a credit number. So like, for example, workers' comp right now in 2019 is sitting at an 88.5% combined ratio. So right now that shows that across the industry, the work comp line of business is profitable. The auto liability, on the other hand, at 114% combined ratio is not profitable. How to understand it simply is that for every $1 of premium for auto, they're paying $1.14 out in claims or expenses and so forth. So they're not making that profit. And as you can see that there, the numbers in red for lines like auto and now for liability in particular, and also property, they're all not trending favorably, which just kind of puts more emphasis on the need to get, additional rate on those lines to kind of turn it around. Does that make sense, Alex? Did I explain it okay?
Yep. Nope, that's perfect. That analogy of bringing in $1 of premium and then spending $1.14 for every dollar brought in really hits home with how the auto line is underwater profitability wise, as you can see, for a decade.
Right. And if you'll recall from the original rate slide, right, they've been getting rate year over year. And even with those rate increases, it isn't enough to turn things around, or at least hasn't been so far. Which just, you know, kind of leads into the fact that there probably need more rate, and you might see changes in terms and conditions. So if you had a lower deductible on your physical damage for auto, it was 500 historically, they might bump it to 1,000, and so forth. So you're going to start to see those changing terms and conditions.
Yep.
If we go to the next slide, one additional thing that, you know, you hear in the news all the time are catastrophes, and how big those losses are, how they can impact your premiums, right? So you, this morning, Hurricane Sally hit, you know, land, and, you know, we don't know what the outcome is going to be, but it's going to be a big one.
Can you dive real quick, just define what a catastrophe would be, just in broad strokes?
Yeah, so a catastrophe is going to be some big, I'm sorry, my dog keeps barking. I'll try to get him under control, but he's being defiant right now from the other room. So a catastrophe is going to be, you know, a larger natural event like a hurricane or a tsunami or something that impacts, you know, a broad number of businesses. It could be the wildfires right now in, you know, on the West Coast, things like that. You can see here, you know, you hear some about really large ones like Hurricane Katrina. Come here, like Hurricane Katrina. But look at the numbers. I mean, 820 so far, you know, that happened in 2019 is far more than I ever would have thought were happening, because you don't hear about a lot of them, but they, you know, it is getting larger. Hold on one second.
And these numbers are worldwide, just to put it in perspective. So the number of events worldwide was 820 last year, 850 the year before. But if you look at this 10-year average and 30-year average going back, you can see they're increasing. And that trend has really continued, particularly in the last 5 to 10 years. I mean, think back to 2012, Superstorm Sandy, and then all of the hurricanes in 2017, Irma and Harvey and Maria, and it keeps going. So
yeah,
I think this trend will continue on this line.
It looks slightly down in 19, Alex, and really that was because in 19 there was more flooding claims than anything, and with flood, you know, it's not an included peril that's covered for property, so people choose to add it or not, and a lot of times they don't add it, and especially if they're in a flood-prone zone, they may not add it due to cost. It might be something that they can't afford, or that they're just going to say it's not going to happen to me, but it, you know, that's why you're seeing that the dollars are down for 19, because a lot of it was uncovered by insurance costs. So Alex, let me ask you this, because I know that you experience this too. What is the most common, you know, comment you get when you talk about catastrophes impacting people's premiums?
Well, we don't have those here. I accidentally buried the lead and put. But I live in Wisconsin. We don't have hurricanes in Wisconsin. Well, sure enough, or earthquakes, right, or fires.
Right. So a lot of times it's hard to understand why a wildfire out west or a hurricane down in Florida, what does that have to do with me? My business is here in Wisconsin. We don't have hurricanes or wildfires, right? And you're kind of right, where you don't normally have those kinds of exposures, but you have to think about the, you know, insurance as a whole is kind of a sharing, you know, situation where if they really charged you for your full, you know, exposure that you had, you wouldn't be able to afford it. So we spread it out across many, many, many different companies. And in Wisconsin, you have other events that aren't as attention grabbing, but in 2019, the largest events came from Midwest thunderstorms and flooding. Increased snowfall in the upper Midwest led to strong snowmelt, which caused a lot of problems for business owners. And then there was thunderstorms, if you remember, back in March and May, and those triggered a lot of flooding problems in the Midwest. The total dollars, 24 billion in overall losses. And that isn't going to get a headline, you know, like a hurricane or a wildfire, but it's happening.
And I'll just share one example. In September of 2016, almost 4 years ago, I think this week, there was a hailstorm that affected the west side of Madison. And I had just one client of mine had, I think, almost $2 million of damage from the one hailstorm just here in Madison. So, you know, those types of events are definitely happening here. They're not, obviously, like I said, attention grabbing, but there's plenty of weather that happens here too.
Right. So Alex blew my my question about the hurricanes here, but I just put this in for kind of for fun, right? So if you think we don't have hurricanes here, well, back in June of 2020, I woke up and heard this headline that that the tropical storm Cristobal was expected to hit Wisconsin, and I thought, what is this? This map shows you that the course of these storms, even though the major brunt of the impact is farther south, they can send rain and wind all the way up to Wisconsin. And it, you know, not that it's causing damage necessarily up here, but to wake up and see that weather advisory that there's a tropical storm was really something. And you know, and who knows, that the last time Wisconsin had a tropical storm was back in 1988 due to Hurricane Gilbert. So I don't know if it'll happen again very often, but it's just something to keep in mind of how powerful the storms are once they hit land.
And keep in mind, we're about to run out of letters for hurricanes in the Atlantic, and we still have 2.5 months left of hurricane season. So,
yeah. Moving on, the next bigger thing that can impact your costs of premium are higher rising claim costs. Just overall on liability lines of insurance, so like auto, general liability, if you have a really bad claim that breaches your umbrella or excess line, that's what we're starting to see more and more of. And you might hear the term social inflation, which isn't new by any means. It's been around for a very long time, but it is a buzzword right now. And social inflation is being kind of blamed for the rising trend in rates for liability. And what it is it's kind of, gosh, it's like society becoming desensitized to large jury verdicts and erosion of trust in corporate America. So basically, juries are kind of not, they're siding with the plaintiffs. They're saying, hey, you should have done better. You really messed up, and we're going to show you. And a verdict that you might have seen a $500,000 claim on is now a $5 million claim or a $10 million claim. And they're just really pushing the envelope to kind of, the view is that they're punishing you. They're punishing corporate America. With the rising claim costs like that, they need to collect more premium to offset it. So that's kind of what that means. These nuclear verdicts are really pushing the envelope for, are we collecting enough premium for the risk? So 2020, hard or soft market. What do you think, Alex?
It's feeling pretty hard, or at least headed that way.
Yeah, so I would agree. I believe 2020 is still hardening. Everything that led into 2020 is still here. There's still pressure. There's still the nuclear verdicts happening. But there's a few other pieces that are coming into play. We're not going to talk about them in detail today, but two items that you should keep an eye on, obviously, COVID-19, right? I mean, in 2019, this wasn't talked about. It wasn't, nobody, right? It wasn't happening, or at least we weren't aware of it. The impact that it's going to have on insurance it's still so new and undetermined. We just have no idea yet what's going to happen. But what we've been seeing are increases in claims due to COVID-19 on workers' compensation lines. We're seeing increased litigation on property for business interruption coverage. and so on and so forth. It's impacting lots of employment practices liability, and a lot of claims that you might not have ever thought would come across your desk, like you didn't keep your workers safe from the virus, right? Wrongful death claims, right? These things weren't hitting the books, right? The insurers weren't paying these claims before. So when there's already rate pressure, and now that we're seeing this pandemic and the unknown, and we don't know how long it's going to last, right? It's going to continue to put pressure on the system.
Yep.
The last one, civil disturbances. This is, closer to home here, right? We have the events in Kenosha recently. We have Minneapolis civil disturbances. We insure a lot of the, we help business owners in Madison, and State Street, right now is severely impacted by civil disturbances and damages to property. So a lot of these claims are coming through the system and putting a lot of stress on those business owners for lots of reasons, but the carriers are also taking a step back and saying, do I want to insure risks on State Street? Do I want to insure risks in Minneapolis? And if so, do I get enough premium for them? So, everybody is starting to kind of take a look at some of those areas where there is potential to have those civil disturbances. And we anticipate that there'll be some changes as a result. So,
Right.
Do you have anything else, Alex, on that?
Well, the big question about COVID, I think I'll address pretty soon here, but that's largely the business interruption. And then the civil disturbances, property coverage is covered. So if a brick gets thrown through your window, most property policies are going to cover that. But so largely, these global factors, they're, like I said, premium is in a giant pool so that everyone can get their losses paid. But the big question then is, well, what can I do for my business to affect my premium? Yeah. So thanks for all of that information on the global market, Di. Let's
absolutely.
to the next. So next we're going to sort of get more local and talk about factors about your specific business that will affect what you're paying in premium. So one question is, who does set these prices? Who are the individuals involved in this? And then I do want to talk about common types of insurance that most or all businesses purchase regularly, such as property, general liability, auto, umbrella and excess, workers' compensation, of course, and then some other familiar lines such as directors and officers, cyber, professional. So yeah, who does set these rates? I think we mentioned that Diana was an underwriter for Travelers for several years, and you've probably heard the term underwriter, but who are those people? So right. I want to talk briefly about the sales process, the insurance purchasing process. So you, the client or the prospective client, will typically with an agent or broker. So you'll come and talk to Diana or myself, and we as an independent agency have a variety of insurance companies that we have access to, and we can present your business as a prospective client for that insurance company. And then so the people that we negotiate are underwriters. So underwriters are insurance company staff that have the authority to accept or decline to insure a particular business or risk, and then they set rates within the guidelines of their company, and they negotiate with us agents and try to create a partnership between the insured client, the agency, and the carrier. Miss the writing process?
No, I like the sticker down here. I love my insurance underwriter. You should love your insurance underwriter. I love mine. They know that. The relationships are really important, and the underwriter really holds the key to either being an advocate for you or not. Yep. And if it can go a long way to know your underwriter, to have that relationship, and to make sure your agent has that relationship with the underwriters, because at the end of the day, they decide if they're how much rate do they really need or not. Do they have flexibility? So make sure you're working with the right people.
And I'll just reiterate a point I think we brought up earlier, is that there's increasing emphasis on underwriting profits, investment income in the insurance business nowadays, because again, the interest rates are very low. The insurance companies are not making nearly as much in investment income as they did maybe back in the 80s, like we were talking about. And so that is part of this hardening market, is that underwriters are really, tightening up their ships and making sure that they're really being very thorough and making sure that they can bring profitable business onto their books. Because again, the insurance companies need to be solvent to pay claims for everyone.
Right. Yep. And if you've had claims, for example, and the underwriter understands what happened and what you did to not have it happen again, those kind of things, that's by knowing them and them knowing you and your story, they're going to be able to get more comfortable with who you are and why maybe they don't need as much rate after all. So that's why it's really important.
Yep. Very important to be able to tell a full story and a good story.
Mm-hmm.
But let's move on to some familiar types of insurance. So property insurance, this is you own a building and some stuff inside of that building. And when that tornado comes through, or the hailstorm or the fire happens, the insurance company is going to pay you to rebuild or replace your building or your property. And then a component of many property policies is the business interruption. And so that component is the insurance company paying you your net profit while you are out of business because you had a covered loss, such as a fire. Now, unfortunately, most property policies are not going to cover being closed due to COVID. Almost so far, I don't think we have seen a paid claim. However, all of the insurance companies are putting their COVID business interruption claims into a bucket for future consideration, because there's going to be more lawsuits coming out of that as that progresses. But so
recently too, there is a lot of litigation like we talked about earlier, and the early verdicts coming in are in favor of the policy and the carrier that say it either, the exclusion is on there or it wasn't direct physical damage to the property. Trigger coverage is what we're seeing. Now, whether or not that's the case for your policy or not, it depends on the language. So you need to read it and make sure you understand how it works.
Yeah, and when you read the policy, you'll see what are covered causes of loss and excluded causes of loss. Oftentimes you'll see a virus or bacteria exclusion. Carriers are getting more diligent about adding a communicable disease exclusion for policies going forward. But typical causes of loss are direct physical loss, such as lightning, tornado, fire, etc. We always try to structure our policies with the broadest causes of loss possible. And so, if you have more exclusions, you're going to pay less, but we err on the side of better coverage. And then a couple of other considerations in terms of how your property will be priced is if you are insured to the proper value. So when you think about appraisals, you get a market value appraisal for a building, and that's going to be a very different number than a replacement cost. So the number for your insurance policy really should reflect the cost today to rebuild your building as is. And so we're seeing a lot of inflation in property, in the property world, due to cost of materials and labor are going up, and there's a skilled labor shortage in the construction industry. So making sure that you have your proper values will affect your pricing. Deductible levels also can affect pricing. If you have, say, a $1,000 property deductible, you will pay more premium than if you have a $10,000 property deductible. So if you have the financials and the risk appetite to take on a higher deductible level, you can save some premium dollars there. And then to add additional costs to the property insurance, if you're going to add additional coverages such as flood, earthquake, etc. Flood, I should really point out, insurance companies really are particular about water and water losses. So flood is its own animal, and water backup from drains is a separate issue than the standard property policies. And so what is the really nitty gritty about how much you're going to pay for your property insurance It's an industry jargon acronym. We've got a lot of those. I'm sure most of your industries have all sorts of jargon and acronyms, but this one's called COPE. It stands for Construction, Occupancy, Protection, and Exposure. Construction, the first item, I call that the three little pigs issue. As you can see from my little graphic here, which one of these structures do you think it's going to cost more to insure, because it's much more likely to burn down or get blown over by the big bad wolf? What do you think, Diana?
Well, I don't know, the straw house sprinkler, it might help out a little bit, but probably the brick one is going to cost a little bit less no matter what. Yeah,
exactly. So there's construction classifications, wood frame, masonry, fire resistive. Obviously, the farther away you get from wood, the closer to steel and masonry and brick, the less you'll pay. So that's a big consideration. That's really mainly focused on fire. This second item is occupancy, as in what is happening in that building. I have examples here in the slide. Are you a fireworks factory or are you an office building? If you're the fireworks factory, you're likely to be paying more for your property insurance because you're a lot more likely to burn it down. And then another consideration for occupancy is owner occupied or leased or rented. So habitational, as in apartments, and rental properties are a little bit difficult for property, and other, not owner occupied structures. Protection means, proximity to fire stations, alarms, if there are sprinkler and fire suppression systems. Sprinklers have become a big deal since they've become part of standard code in the last few decades. There's a lot of issues around sprinkler systems, like, are they water? Are they foam? What's their capacity? That was a big issue for you as an underwriter, Diana. Can you comment briefly?
Right. Yeah, sprinklers, having them is best case scenario, right? And if you have them, it's better than not, but it's not always adequate for what you're protecting. So understanding your exposure and what type of system is needed to protect it is key. So a lot of times we kind of run into maybe a situation where the original building has a sprinkler system, but it wasn't strong enough water pressure for a plastics manufacturer, for example, right? It wasn't adequate to contain the fire from burning plastic. So a lot of times we, while there was a sprinkler in place, we would maybe have to either, charge a little bit more for that exposure if we could get comfortable with it, because it didn't have quite the right sprinkler. You mentioned habitation. A lot of times apartment buildings might be sprinklered, and they're considered life safety sprinklers usually, which means that if there's a fire, they're going to go off and they're going to hold off that fire long enough for hopefully everybody to get out, but it's not really designed to protect the whole apartment structure. So you are probably still going to see that building burn to the ground. So, just knowing who you are and what type of exposure you need to protect is key. And it can be costly to upgrade your sprinkler system in that moment. It could be $50,000 or $100,000, but if you can save annually, year over year on your insurance, it could actually you could come out ahead. So, just things to think about. If this sounds familiar to you, let's have a conversation about it.
Right. And many older buildings did not have to install sprinklers when they were built. And the code has since changed, and some of those businesses are in a place where there are maybe not as many insurance companies that will insure their property at all, let alone for the right price until the sprinklers are added. And sometimes it takes an actual event and then some sort of fire or something, and then they have to rebuild and retrofit is sort of the triggering event. So it's not often that people do it voluntarily. And then the last item here in our little acronym, exposure, is really just your proximity to, or your exposure to, various types of losses. So if the fireworks factory, to use that example, is next door, you have a higher exposure than if your next door neighbor is a church or an office or something of that nature. And then your weather hazards are also a big deal. So for example, in the Great Plains and like in east of the Rockies, we're seeing wind and hail is a huge issue. So insurance companies are putting up bigger wind and hail deductibles and charging you the same as they might have. So it's where you're located has a big effect on what you're paying for property premium.
Yep.
The next pretty common insurance, you're going to carry general liability. So this is just if you are liable for inflicting bodily injury or property damage to a third party just arising out of your business activities. Just about, well, every business has this. I don't know who doesn't. Everyone should, right?
Hopefully, if you don't, again,
Give us a call.
About that. Yeah, I mean, general liability is going to protect you. Even an office is going to have, visitors come on site. You have a slip and fall exposure to somebody in the parking lot. We have icy, snowy winters. Inside, you could have a customer, a client come on site and trip over your mat, and so forth. So even just office exposure, usually do carry liability.
Yeah, those slip and falls are probably the most common type of claim here. But how you're going to get charged for premium, the most common bases that insurance companies use are payroll, sales, units, area. So if you have more sales, you're doing more business activity, you're going to pay more. The rate is going to be set by the underwriter based on a variety of factors, including what your industry is, what your claims experience is, and what type of activities you're engaged in. Units would be typically like apartments. So if you have 20 apartment units or 500 apartment units that you rent out, you obviously have larger exposure the more units that you have, and so you're paying more premium. And then the area is more of a commercial real estate type exposure. So if you're renting out office buildings, that's usually based on the area. And then a big consideration for what you're paying premium wise too is that payroll and sales, those numbers that can fluctuate, will be audited by the insurance company at the end of the policy term. So at the beginning of the year, you put up an estimate on your policy for what your sales or payroll will be. And if you say, hey, I'm going to have 2 million in sales this year, you pay your premium on the 2 million of sales. The end of the year, the auditor comes in and you share the books with them, and turns out you had 3.5 million of sales. You're going to get charged for that extra 1.5 million just right there in a lump sum at the audit time. So it's important to put forth a good faith, pretty as accurate as you can estimate to make sure that your general liability premium is close, so you're not hit with a bill at the end of the year. And then I touched on the rates are determined based on what your activities are. I mean, you see our little graphic here, you've got a construction site. That's going to be a much higher hazard, bigger liability hazard than, say, an office or a church or something like that. And then, higher cost areas include like Chicago, California, New York, areas that have, higher litigation and just more regulatory activity are going to cost you more. So going back to Diana's slide about, hey, we're in Wisconsin, we actually, from this standpoint, that does, from the liability standpoint, gives us a little bit of an advantage in terms of cost over being in some of those higher priced areas.
Yeah, one thing I just add is, Wisconsin, it's a large manufacturing population, and based on, what you're manufacturing as an individual company is going to weigh more heavily. Like Alex said, construction is going to be higher than office. For manufacturers, what are you manufacturing and who's using it, and who's likely to get hurt using it, even if that's not the intended user, are all things that the underwriters think about when they determine how much premium do they need for liability insurance.
Right.
If you have a consumer product like scissors, right, you're going to see a lot higher rate, even though you're like, it's scissors, everybody knows how to use them. Well, people get hurt with them. Compared to like maybe
pick up that scissors and see, oh, this is the brand of those scissors, I'm going to sue them.
Right, and compared to maybe like a big set of scissors or something industrial that has an industrial use, that while that's still hazardous and could hurt somebody, the thought process behind that is, it's a consumer is more likely to probably sue if they get injured. The industrial use, setting, they're probably trained on how to use, that piece of equipment and so forth. So who is the end user, and what possibly could happen with that, whatever the product is, even if it's intended use or user or not. So.
Yeah. Next, we'll get to our a very pricey, as we learned earlier, very pricey insurance here. Auto, as we discussed earlier, is really, it's getting, rate is coming, getting 5, 10, 15% each year, the last 2, 3, 4 years. And the bulk of it is in the liability portion. So, there's two really main components of your auto policy. You've got your liability. So if you are an at-fault accident and you cause injury or damage to a third party, that's your liability coverage. And then your physical damage is just the cost to repair your own vehicles, your comprehensive collision. Your cost there is going to be based mainly on your types of vehicle and then your deductible levels. But liability has been a huge thing. There's, like Di mentioned earlier, the social inflation aspect and the distracted driving are just big concerns globally with auto. And so what's really affect your specific auto premium is your fleet characteristics and your company's policies and procedures. So your types of vehicles, you have broad strokes, there's private passenger, light truck, and then like heavy trucks and tractors, dump trucks, that sort of thing. You're gonna see the lowest premium on probably the light trucks, your Ford F-150 or small SUVs, a little bit higher on private passenger, and then your heavies are gonna have quite a bit higher liability and physical damage premiums. So, and then the other characteristic of your fleet is the distance driven. So if you have a lot of vehicles on the road and a lot of miles being driven, you have a much higher liability exposure on your auto side. And so it's gonna drive up your cost per unit. And of course, your claims history too. I think we maybe haven't mentioned that enough, in that the more claims that you have on your books in all of these lines are going to affect your pricing. But because of the way that auto is trending these days, it's especially acute in this line of business, what you're going to be paying with a claims history. And then from a policy and procedure standpoint, if you can tell a good story to your underwriter that you have good fleet safety programs and fleet management and cell phone use policies in your company, that's going to go a long way to helping keep your rates stable. And then if you're checking your own employees' motor vehicle reports, that's what MVR there stands for, and making sure that you have a procedure in place for what an MVR looks like and what it contains and who can drive, and making sure to follow those procedures to the T so that you only have people with clean driving records out on the road.
Yeah, I think, the motor vehicle record checks are important. The underwriters always ask, they want to know that you're not letting just anybody drive and that you're aware of the people that are driving so that they can defend you in the event of an incident. And if at the end of the day it's found that, well, you knew they had 2 DUIs, or you knew that they were driving without a license, for example, things like that, you still have coverage, and they can defend you, or you can, they might decide to settle a claim, but they're more likely to have to settle if you're not protecting yourself and making sure you're a good driver. So. Yep.
Good point. Very good point. Umbrella.
We have about 11 minutes, Alex. So
I know, I'm trying to move forward. So umbrella and excess, we don't need to spend a whole lot of time on. It's just a reminder. This is the liability coverage. It's not a catch-all. Doesn't cover property. It is the liability, third-party liability. Mainly, the pricing for your umbrella is driven by the policies that it sits on top of: your auto, general liability, player's liability. The biggest driver of umbrella claims these days is auto accidents. So that auto pricing going up is really driving umbrella pricing up. And then just the hard market on umbrella is the line that's been hit hardest by the hard market. So we're seeing, maybe with your limit selection, maybe you bought 25 million last year and it cost you $100,000. This year you might get 10 million for $100,000. And that's just the way the market is, but it's really driven by mainly the pricing is driven by the underlying exposures. And I definitely want to get to this next one, work comp, because it's the biggest cost premium wise for a lot of businesses. Really the biggest thing driving your costs in work comp is your claims history. It really, like, having a safe workplace and implementing safety procedures and loss control and risk mitigation really helps here, because the experience mod factor is a calculation that puts your individual claim history up against expected losses, and it's kind of a convoluted calculation, but your payroll levels and your classification, and then your claims, and then they create, it's a whole thing, as we all know. But anyway, if you have no claims, you're going to run up against the minimum modification, which means you'll get a premium credit. So for example, if your minimum possible mod is 0.80, you'll get a 20% credit on your work comp premium. And then if your mod is 1.20, you'll get a 20% debit. And then the other thing is, in some states like Wisconsin, for example, the state authority sets the rates. So your payroll times your rate is going to be the same across Wisconsin, no matter if you're the same classification, and then your premium changes based on your experience modification. And then in Wisconsin, the carriers can offer a dividend where you get some premium back at the end of the year, and that's how they compete for your business. And then other states like Illinois, there's a range of rates that are acceptable, and the underwriters can apply some credit to those rates. But really, the thing I want to stress for workers' comp is the more you can keep the claims down, the better it is, because the experience mod factor is a 3-year rolling calculation. So if you have one really bad year say you have a really bad year in 2020, that's going to stick with you on your premium in the 2022, 2023, and 2024 years.
Yeah, and I would just add quickly, the best claim to have is not to have one, right? So try to prevent losses.
If
but
possible.
if you have a claim, do everything you can to keep that employee engaged and bring them back to work. So return to work is huge. It helps keep what flows through that experience mod calculation down if you aren't paying the indemnity or lost wages. So even if you can bring that employee back to just kind of hang out and file things and keep them engaged and in the healing process to get back to work quickly, it's going to save you a lot of money down the road.
Yep, absolutely. Yeah, return to work is huge. Even if if it's a plant worker from the floor, you have him or her working in the office, it really helps. Okay, so briefly, we'll just touch on these other lines here. Employment practices, you're looking at your number of employees is going to be your biggest driving cost driver. Directors and officers, really your financials, financial stability and health of your company. These two lines have been hit really hard with the COVID uncertainty, because a lot of employees have been laid off and there's a lot just less certainty about the future. Professional and pollution are really just industry specific and kind of based on your sales. And then cyber is the other hot issue right now. And there have been a lot of ransomware claims that's driving that market to harden. And so your IT and network controls are a huge thing. And then your premium is going to be based largely on your sales and how you answer all those network security questions when you fill out an application.
All right, we got 5 minutes.
Bring it all together. Bring it all together. So what do we do with all this information, Di?
Yeah, so what do you do? So if you haven't renewed yet in 2020, you will be soon, or you will be in early 21. And really just understanding how those bigger market influences can impact your premium is huge. So stay informed, talk to your agent or broker, make sure you understand how those factors can impact your business.
And then really understand what is happening inside of your 4 walls, or your proverbial 4 walls. Make sure you're reviewing your open claims and loss runs with your agent on as regular of a basis as makes sense for you. Experience mod analysis and projection is important. And then, as we touched on in work comp, just make sure to just provide a really safe work environment and you have help, your insurance company and possibly your agent or broker will have loss control services that they can provide to you, sometimes included in your premium cost and sometimes for a fee, but those can really go a long way to helping reduce work comp claims and other sorts of losses.
Yeah, and most importantly, I just think being proactive and staying ahead of the process is going to help you in the long run. So if you're not having any strategic conversations with your agent, you should be doing it early. I would say at least, you know, touch base midway through your policy period to make sure that you understand, you know, what's happening in the market and how it could impact you, so that you can have that plan of, do we market or not? Does it make sense to try to renew early? Is this, you know, 8 to 10 to 12% rate increase the best there is in the market, or should we check with other carriers and see if it makes sense? Because it costs a lot of time and effort on your end to market to new carriers too, right? So is what you're paying competitive in the market for the current market? I would say those conversations have to be frequent, and they have to happen. If you don't have those conversations, or you don't hear from your agent until they bring your renewal in, it's too late. There's not really much that they can do for you at that point. So that's my recommendation, is just make sure you're communicating. You know, we put the blueprint down here. The blueprint is a process that Houseman Johnson has been utilizing. It's really the difference between helping somebody just get a price or a rate, and really taking a look at everything else that can impact your total cost of risk. So if you're just simply worried about the rate for 1 year, you know, you might be missing the mark on other items that you can pull, financial levers and triggers that can make a huge difference in your insurance program and your total costs. So just things to keep in the back of your mind, as you know, it's an annual renewal cycle, right? So like I said, if you're in the middle of your cycle somewhere, whether or not you just renewed, or you're looking into the horizon at it, you know, make sure you're not just looking at the price. Make sure you're looking at coverage and retentions and deductibles and so forth. And does it make sense for you?
Absolutely.
All right.
I think we've made it to strategy. Yes.
Strategy.
We have a few minutes for questions, so I'll hand it back to Rachel.
All right. If you do have any questions for Di or Alex, go ahead and type them into the questions feature right now. We do have a couple minutes. I'm also going to pull up, oh, we already pulled up their contact information. So if you think of a question later, go ahead and you know, type that in. Or you can, I'm sorry, you can go ahead and email them or call them if you do have questions about anything they presented today. One question that did come in, someone wanted to know how much time it takes to get all those letters behind your names.
Oh gosh, more than I'd like to admit, probably.
I think there's multiple hundreds of hours, I think, in class and exams.
I bet.
You know, when I started in the industry, everyone said, do it right away, do it while you're young. And, you know, that probably isn't what young people really want to do. I did take that advice for most of it and got it done in my first, you know, 3 to 5 years, when I didn't have kids and I wasn't married, and, you know, I could just spend more hours on it.
Mm-hmm.
Yeah, no, I got to work right away with all these. I just finished my certified risk manager about a year ago, so I think it took me seven years of regularly attending classes and a bunch of exams to get everything that I have there. So.
All right, well, we are out of time, so I'm going to go ahead and wrap it up. If any questions do get entered, we will go ahead and have Di and Alex email you to answer them. I'm sorry if we weren't able to get to them. We do want to thank Di and Alex for all their expertise today, and we want to thank everyone for attending the webinar. Please remember to fill out the short survey as we close things up here. Your feedback is really important to us, so we can keep bringing you these topics. And we do hope you can join us for our next webinar on October 21st, which will be the profound impact of middle managers on office culture. Thanks, everyone. Have a great day. Take care.
Thank you.
Bye.
Bye.